This is far better than owning a 401k. I've answered this question numerous times in my career. Should my children own life insurance on me? Or another way to look at it, should I own insurance on my parents? You'll get the answer in this episode. This concept is probably one of the most underutilized strategies on the planet. In this episode, I'm going to share with you, I'm Doug Andrew, how I own life insurance I owned it on my father. He's since passed away. On my father-in-law, who has passed away. My mother-in-law, who is now age 90, I couldn't own it on my mother. She became uninsurable before I learned about this strategy, and why all of our children own life insurance on me and my wife, their mother. Let me explain this in a way that will help you understand how life insurance really works. There are actually 4 or 5 main parties to a life insurance contract. So you have the insurer, that's the insurance company offering the coverage, okay? Most people think of life insurance as death insurance, that it's there for death. Well, that's fine. I use most of my life insurance for living benefits. But let's look at what it does and what it really creates rather than just looking at what it is. See, the insurance company will provide a death benefit when the insured dies. So you have the insured who has the life insurance on them. Now you have the owner of the insurance policy, which is usually the insured, but it doesn't have to be. And then you have the premium payor. That's the one paying the premiums into it, which is normally the owner and the insured, but it doesn't have to be. And then you have the beneficiary. Now the beneficiary is the one receiving the life insurance proceeds upon death. Now, there can be different parties on all that. I could have a family trust, what I call a family bank, own a life insurance policy, or I could have the trust be the beneficiary of an insurance policy that is owned by the children, but it is the insured is me or my wife, the patriarch and matriarch of the family. And so you can have all these different parties, and the premium payors can be the kids, or I can be the premium payor on a policy on my parents. Now, there are some rules you have to abide by. There must be an insurable interest between the insured and the beneficiary. In other words, you have to prove to an underwriter at the time you apply for the life insurance that there would be an economic loss suffered by virtue of the insured's death, that economic loss would be suffered by the beneficiary in order to justify the insurance. And so that's called the reason and justification for the insurance. You also need to make sure that if you have a life insurance contract in place, who the owner is. Now, typically the insured is the owner, but doesn't have to be. The owner is the one that receives all of the tax-free growth, the benefit, and so forth. They get to make all the changes and call the shots. So let me bring this into perspective. Everybody has what is called insurance capacity. When you're younger, the insurance capacity is usually a factor times your income. So when I was 30 years old, my wife and I, we were already parents. I think at age 30, we had already had 4 or 5 of our 6 children. By age 32, we had our 6 children. If I were to pass away in an accident or some heart attack or something at age 30, I would have left an economic loss. And so I insured myself to make sure that Sherry, my wife, and our 6 children would have what Daddy would have provided had he stayed around. And so most insurance companies say you can insure yourself up to 30 times your income. So let's say I was making $100,000 a year. So I could qualify for $3 million of life insurance. You can't have more than that because there are crazy people out there that would insure themselves for millions of dollars and then strap bombs around them and blow themselves up. They've actually had people do that to fund their terrorist organization or their cult. So there is a capacity. You can only have so much insurance. That is usually a factor of your income when you're younger. Now, as you get older, if I passed away at age 60 or 65, we're empty nesters at that stage, and my life expectancy is less. So I would only qualify for maybe 6 to 8 times my income if I'm 60 years old. But my income might be substantially greater at the time, but then the insurance companies will insure you based upon a factor of your net worth. So if my net worth was 10 million, they will insure me for 10 million. They don't even have to ask the question, if you're worth 10 million, you can be insured for 10 million. Sometimes companies will insure you for more than your net worth. That's called insurance capacity. It changes as you get older. It's a smaller factor times your income, but your income is greater. Or you can be insured for up to 1 times your net worth. I have found that the vast majority of Americans have underutilized insurance capacity. And they go, well, why would I pay for insurance if I don't need it? Quit looking at what it is. If you don't need the insurance, if you have the money, it doesn't mean it's not a smart thing to do. So if I have insurance capacity that I'm not using, how could I use that as an asset? Well, maybe if my kids bought life insurance policies on me, or I bought them and they funded it, they were the premium payors. Let's do the math. So I've had a lot of financial gurus who, of course, are proponents of buy term and invest the difference, and eventually 30, 35 years down the road, okay, you don't need the life insurance anymore, you are self-insured. Well, that's great, but I've often said, before you let that life insurance go, why don't you see if your children want to buy that policy on you? Because you can actually sell your life insurance back to an insurance company and they'll do the math. So let's do the math here. Let's say that I have a capacity of $1 million of insurance, and maybe I have enough for all of my 6 children. My kids, they can choose to own, or I can change the ownership on my policy to my children, or they could maybe apply for insurance on me, but they're going to have to prove that there is an economic loss suffered by them. Otherwise, you have it underwritten under normal underwriting guidelines, and then you can change the ownership thereafter. To minimum fund that insurance policy for a 60-year-old, for example, $1 million of insurance, you could probably fund that for $500, $600, $700 a month, definitely for $1,000 a month. Or you could maximum fund it, and they can put money in, and it will knock the socks of a 401k or an IRA as far as tax-free rates of return, because the money inside the insurance policy is tax-free. But let's just minimum fund it for a second. So I tell my kids, you know what, I have insurance capacity that I don't need or I'm not using. Would you like to utilize that? Let's say they put in $500 or $1,000 a month into $1 million policy on me. What does that mean? If they're the beneficiary, anytime Dad dies, between now and if I live to be 80, 90 years old, they will be endowed with $1 million tax-free. Do you know that an IRA or 401k would have to generate $1.5 million tax-deferred to net them $1 million tax-free? And they would have to probably sock away $500, $800, $1,000 a month for 30 years and get an 11 or 12% rate of return to end up with $1.5 million to end up with a net of $1 million after tax. Why do that? If they own $1 million policy on me and I die tomorrow, 10 years from now, 20 years from now, 30 years from now, they'll have $1 million tax-free. That's better than any 401k they could ever put their money into by owning a life insurance policy on Dad. I want them to be automatic millionaires, all of them, the minute I check out. It's a powerful concept, but when you understand what it does, it's far better for them to sock away $500, $700, $1,000 a month into a $1 million insurance policy on Dad than putting the same amount into a tax-deferred 401k. It will take 30 years to accomplish even close to what $1 million tax-free in an insurance death benefit would provide for them. This is why my children are encouraged to own life insurance on me. I have owned it on my dad, my father-in-law, my mother. I'm not trying to get rich off of their deaths. I just know the math, and I want to have a legacy and use that money to provide funding for college, for religious missions, humanitarian missions into perpetuity in their name by simply using their life to insure. So look at somebody's life to insure as an asset. Why it can benefit you and your family bank is what I call it, and it's far better than socking away the money in some investment that's going to be taxable sooner or later down the road. Make sure your money's tax-free and that it will be self-completing anytime the oldest patriarch and matriarch passes away. Every time somebody passes away in our family, we get a tremendous infusion of tax-free capital that blossoms the family bank into perpetuity. You can do this too. I'd recommend you watch this episode and learn more about what I call the laser fund. In my most recent book, it talks about how you can use the laser fund, life insurance, not only for living tax-free income benefits, but also as an alternative to traditional ways that most people save in IRAs and 401ks.